Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Well, I can hear you in one ear. Little technical difficulty. Wow. Losing my voice. Sound like another person. I don't know if that's good or bad. But anyway, got good news for you. The market's still really strong. I get asked all the time, do you think it's going to have a correction? Well, it will sooner or later. But I got to tell you, the things are going well. In the economy, they're going very well. Interior, there's starting to be some stocks are spreading out. So far over the past, I don't know, probably 3.5 years, the large company stocks have dominated everything. That's starting to change, and you want to be aware of that, and you want to come to the seminar that we're going to have on the 18th, which is coming up pretty quickly. Go to my website, bullingtoncapital.com. You can sign up. It's free. Should be fun. I'll show you how you can track the market. A lot of changes have occurred in the market over the past 5 years. The change has been blindingly fast. I mean, I've been doing this for an extremely long time period. In fact, I told somebody, I've been doing this for 30 years. The guy was like, no, you haven't. I'm like, yeah, I'm actually sad to say that. It's been a very long time. And in fact, I got my securities license right after the crash of 1987. Anyway, so if you want to go to the website, lots of changes. It presents some risks, and there are also opportunities. And I think this is a really good time to be investing. This is a very good time to be investing. You get a 10 or 15% drop, I would welcome that. I would really welcome that. Because first of all, I'm not 100% invested anyway, and I never am. I don't think anybody should ever really do that because I don't think it's necessary. I don't think you need to take all that risk. But more importantly, it gives you some dry powder. You've got to be able to take advantage of these corrections when they come along, because it's not if there's going to be a correction, it's when there's going to be a correction. That's just the way it works. That's like wintertime. You know it's coming, you just don't know exactly when. And you don't know exactly when it's leaving, but you know it's leaving too. So that'd be pretty good. And I'm going to do something at this upcoming workshop. Let's see here. Yeah. I think what I'm going to do, I'm going to give 2 Cavs tickets away. They're very good seats, by the way. Section 118, seat numbers 7 and 8. And I'm going to give 2 Cavs tickets away at the workshop. The workshop is the 18th. So it's not this Thursday, but it's the following Thursday. And like I said, you can go to my website to sign up for it. I'm going to give a couple of Cavs tickets away. And boy, those guys playing well. Yeah, did you see the first game with, they call him IT. I love that. Isaiah Thomas, IT. I guess I'm a computer nerd. Anyway, very good. I love the Cavs this year. I don't even care if they win the whole thing. I think they have a really good chance, especially if they come together. But that really doesn't have a whole lot to do with financial markets. And you can, by the way, feel free to give us a call, 216-901-0945, 216-901-0945. You've got mutual funds out there. You've got exchange-traded funds or stocks that haven't kept up with the overall market over the past couple of years. Don't worry about it. Really, don't worry about it. They're going to catch up. Eventually, they do. If they're good. Eventually, they do. That started to happen this year. Categories that were lagging. Remember small caps? They were about a little over a year ago. They were down 25%. They come ripping back. And international emerging markets, they were stinking up the joint for 5 years. That's a long time. Yeah, now they're coming back. So if you've got a well-rounded portfolio, you've got small, intermediate, or small, mid-cap, large cap, international, emerging market, you got good funds in those categories, this should be a good time for you. I think over the next several years, it's really going to be pretty good. Now, why am I saying that? Well, this has been one of the slowest recovery. Actually, this was the slowest recovery. During the Depression, GDP growth picked up faster. Remember when they were, I don't remember, I wasn't born, but I remember studying about it. Tennessee Valley Authority, the New Deal, all that stuff. They successfully picked up GDP growth for a little while, so you got a break. And then it started to slow back down again, and then World War II came around, and after the end of World War II, the government had spent a whole bunch of money that it didn't have. Sound familiar? And the debt to GDP was actually higher than it is now. Think about that for a second. The debt. Everybody keeps talking about the debt. They've been talking about it for years. They always talk about it because it scares people, and they know that, that's the predecessor to the fake news. So you've got debt to GDP that was 145% after World War II. And that led to some pretty good years. I mean, some really good years, both in stocks. Interest rates went up. Now, they weren't as sophisticated back then. The Fed was not nearly as sophisticated as it is today because they've got all that experience that they've learned from since then. And I'm not sure that they'll raise interest rates a lot. I think you might get around 3% or so. But I don't think they'll raise interest rates a lot. Right around 3%. I could see the our short-term bonds kind of topping out around there, which is not bad. It's better than it is today. It's not 5 or 6%, which is long-term average. That's still significantly below average. But it's not enough to send the economy spiraling down. So that's a good thing. Growth rates are going well. Inflation's been unbelievably stayed in check. That's pretty interesting. Now I know if you're older, incidentally, your inflation rate is a lot higher than young people, than the younger generation's inflation rate is, because younger people aren't going to the doctor that much, and healthcare costs have been rising at 2 to 3 times the rate of inflation. Actually, it's one of the big contributors to inflation. But if you're young, you're not going to the doctor. Most of you aren't, and you're not feeling that. So older people are. They feel that. They feel their inflation rate is probably twice the inflation rate of somebody that's half their age. So anyway, we don't have super high inflation. That's a good thing. Interest rates probably not going all that much higher. A little bit. It'll be a brief reprieve. Stocks aren't overpriced, especially if you get outside of the top 50 stocks in the S&P 500, and they're not even that much overpriced. You get like I said, you get a 10 or 15% correction. You have to be an investor. You got to step up and buy into that. Now, you can't buy into it if you're 100% invested right now. You need some money sitting around. And typically at Bullington Capital, I have 20% of my money in cash. 20% of my money at all times. And that's probably not enough. I should be more like 70-30. Because when you get these big corrections and you're sitting there adding 20%, or even, if I go, typically I'll take about half. So adding 10%, yeah, it helps, but it doesn't help as much as it should. So I guess this year I'll try to tone that down. Go with the 70-30 split. Be a little conservative. I'm getting a little old. My 5th grandbaby is due any second. That's hard to believe. I have 5 grandkids. This is going to make number 5. So anyway, economy's going well. Stock market overall. The other sectors are actually starting to catch up with the large caps, which is good. A little later in today's show, I'll talk about some individual companies that are going to come up, that came up on my scans in the last couple of days. Some of them I already own in a little fund that I run, and that's been looking up. It's been doing much better. It's about time. Very frustrating for money managers when you actually manage individual portfolios, and the conditions aren't right for your particular style. Value-oriented people call that value traps. They get stuck. They buy a company that's underpriced, and then it stays underpriced or gets even more underpriced before it starts going up. And you've got the other side, the momentum, which I kind of lean a little bit towards both. I like for stocks, I'll tell you what, one of the stocks that I own right now is called Shutterfly. Well, it was up 4% yesterday, and it came up on my scan. The scans, which I'll show you at the workshop. I'll show you the scans. They're relatively simple to do, especially today. It's unreal how easy that is to do. So anyway, Shutterfly's up 4% on the day. It was down about 3% the day before, but the volume hadn't really increased that much. Volume increased. It went up 4%. It's actually a new 1, 2, 3, 4, 5. It's a 5-month high. It's not a 6-month high yet. The stock had gotten kiboshed earlier in the year. Now it's coming back up, and its valuation is relatively low. And that's a good thing. When you've got a stock that's moving whose valuation is relatively low, that's a pretty good thing. Like I said, I have to tell you, I already own the stock. So, in fact, I bought it a couple weeks ago. Was a little upset when it went down right away. But I have my trailing stops in there, and we're going to explain that whole thing. And by the time, what I'm going to do at the workshop is I'm going to hand out a little, the ebook that I'm producing, and I'm going to ask for feedback. So anybody that comes to the seminar gets that for free. Come to the seminar, you're going to get this book, which is basically a little course that I'm putting together for people who want to do this. Because I tell you, it is fun. It's fun to do, and it's a hobby that can make you money. How many hobbies do you know that can actually make you money? Most hobbies end up costing you a lot of money. And this is a lot more fun. I mean, it is fun. Sometimes stressful? Yeah, sometimes. In fact, I was just talking with my show's producer this morning and about how normally I go in, open the trading platform, place my trades, and turn it off. I'm too old to look at it anymore during the day. It'll be up or down $40,000 or $50,000 every day. So, in fact, there are times when it's down $20,000 or $30,000 in the first couple hours, and then by the end of the day, it's up $20,000 or $30,000. And you're going, wow, one day. That happens a lot, by the way. It really does. So I'll show you how to handle that, how we handle it. And it's all about managing risk. It really is. All investing is about managing risk. If you're going to be a good long-term investor, you got to learn how to handicap what you're doing and control that risk. That's the only thing you have control over, by the way. You don't have control over the stock market. You can't make a stock go up. I mean, unless you've got a couple $1 billion, then you can. But if you're not in that category, that's beyond your control. So the only thing you can control is your portfolio. And I'm really excited this year. 2018, I think it's going to be a good year. I think it's going to be a good year for stocks. I would welcome a 10 or 15% pullback. I really would. I don't know that we'll get that. I don't know. Anybody that tells you they know for sure probably just doesn't know any better, or they're selling something. Nobody knows. But I would welcome it, especially at this point. Boy, the market's really run a long way without a 10% correction. It's been a long time since that's happened, and normally it's every 12 to 18 months. And I would really welcome that because the economy is really strong. It's getting stronger. There are some industries that are popping up that are actually starting to contribute to GDP growth in kind of a big way. And we'll cover all that at the seminar. So if you want to sign up for it, again, go to bullingtoncapital.com. We hold it at Tri-Cities Corporate College over there on the east side. It's a really nice facility. It's where they filmed that movie about the Browns with Kevin Costner. I can't even remember the name of it now. But in fact, that was filmed right across the hall from where we host the meeting room. It's pretty funny. It took me a while to figure that out. They came in and put a whole bunch of stuff in there just to make the movie. Anyway, if you'd like to call, the number is 216-901-0945, 216-901-0945. Another thing we're going to be doing in 2018, my furniture for their new office, we're moving just a couple miles away. It's going to be right off of I-77 now, a lot easier to get to. That was one of the main reasons I wanted to get over there. And it's very close by, very close to where I am now, but it's a little more convenient to get in and out of. And I'm putting together some things in the office there. I'm going to put a big monitor up on a little table so people can come in. If they want to get their stuff organized, one of the services that we provide at Bullington Capital is it's called an account aggregator. But this one's not just an account aggregator. The account aggregator is something that lets you look at all of your accounts that you have, not just the ones you have at Bullington Capital, but you can sign up for all your accounts, and you can see everything in one place. Now, one of the nice things about this one is it also tracks your all the transactions. It's kind of like Mint, and I think it's better than Mint.com, which is probably the most popular one. And the reason I think it's better is they don't sell your information to a bunch of people like Mint does. And it's a read-only, which means nobody can get in there and do transactions. And what's really nice about it, I mean, if you're worried about somebody getting into your accounts, put it on there. And if you can set these security settings. I'm going to show anybody that wants to know how to do this, clients, any of my clients, you come in, I'll show you how to set it up so that if there's a transaction that's above a certain dollar amount, you get an email. I get an email every week. And I have an email that sets up at the end of the week that shows me a summary of all the transactions. How cool is that? I just can't believe that we can do this kind of stuff. You know how hard that was before? And the thing I really like about it is you can pull in all your transactions from all your credit cards, all your checking accounts, banking accounts, investment accounts, and you can export it to an Excel spreadsheet. So if you want to take a deep dive and look at it, find out exactly where all your money's going, it's a lot easier because you don't have to log into 5 different places. You don't have to re-input all the data. It's a really nice tool. And those are just a couple of things that you can do there. This thing is really, it's a hot rod. Now that I hear the music, that means I'm going to have to hot rod it on out of here so the commercials come back. Can play. You listen to Bill Bullington right here on 1420. Stay tuned because I'll be right back.
Out here in the field,
and we are back. You're listening to Bill Bullington. I'm here every Saturday morning from 11 to noon. By the way, you can pick this up on Apple iTunes, the podcasts, and you can also get it at 955thefish.com. It's hosted as a podcast there as well. And I really like that station, by the way. It's a great station. I think it's actually the one I listen to about 90% of the time now. So, again, I'll just remind you about that seminar coming up. It's on the 18th, January, Cleveland Tri-Cities Corporate College, right over on the east side. You can go to bullingtoncapital.com to sign up. I think this is a very good time to be investing. I know everybody's nervous that you haven't had a correction in a really long time, and that's a good thing, by the way. That's a very good thing. When the public is nervous about what's happening, what they think is going to happen has a tendency not to happen. Now, what would make me nervous if everybody was chomping at the bit to get in? That would make me nervous. In fact, I can remember back in 98 and 99, excuse me, people just couldn't wait to get their money into the stock market, and particularly the S&P 500, which they didn't realize was heavily influenced by all the technology stocks that were in there. The S&P 500 is not a really well-diversified basket of stocks because of the way that they invest the money. They market cap weight it. If you don't know what that means, don't worry about it. They put more money in the bigger stocks than they do the smaller stocks. Everybody goes, and that works really well until it doesn't. Then you get a big whopping 50% drop. It takes 10 years to recover from. So it's great when it's going up. And when it's going up, it'll beat just about everything. In fact, market cap weighting has worked its way into almost every category now. And I understand that big institutions have to do that. So if you want to try to take out some of that risk, or at least spread the risk out, you need to hold some things other than just large cap stock funds. And some of those categories have not done well the past 3 or 4 years. This year, they're actually doing much better. Actually, the past 18 months, they're doing much better. And that's kind of how that works. The S&P 500 will beat a lot of companies for a long time period, but eventually, and if you look out at over the long term, small and mid caps outperform large caps. The small and medium sized companies will outperform larger companies over time. And it only makes sense when you stop to think about it. Do you think Microsoft was growing faster when it was a $4 billion company or when it was $400 billion? I mean, think about that. In order for Microsoft to get and I don't even know, I should probably check that out. I forgot what their market cap is. Oh, it's too late now. Can't get back to that screen. But my point is that when the companies are much bigger, they're growing much more slowly. And yeah, they'll get popular and their share prices will go up. In fact, that's what happened to Microsoft. Its share price got to a level that it should not have been at for about 10 years. And you know what happened? It went down and sideways and took over 10 years to recover. That's what happened. And it really upset a lot of people that didn't know about that. So it's when you're only looking at performance, you're only looking at half the picture. The other half is the risk that you're taking. And you really need to try to do the best job that you can to manage the risk and understand when you move your money into other categories, those other categories are not going to perform at the same time. The vast majority of people, I can tell you, having done this for the past 30 years now, the vast majority of people want to go up when the S&P 500 is going up, and they don't want to go down when it's going down. And and they look at that and they get upset if they're not going up as fast as the S&P 500 is, and that they didn't get out. That's the biggest problem that you have, because that is an incredibly difficult. When I say incredibly difficult, I'm talking about the level of difficulty there would be like the Browns going undefeated for the next 4 years in a row. I mean, there's a chance that could happen. I wouldn't want to make that bet, at least not with any, not more than $10. I'm laughing because there was a roommate of mine. This guy worked for the Fed, by the way, the Federal Reserve. We would laugh about that all the time. I would bet, but I wouldn't bet more than $10 on it. It's an inside joke. Anyway, so when you're investing, you got to look at the kind of risk you're taking. Right now, you've got international emerging markets doing very well. They should, especially emerging markets, they're growing so much faster than we are. And the faster growth should lead to higher share prices. Try telling that to anybody that's been holding it for the past 4 or 5 years. They're upset. And they're upset because they just didn't know that that's normal. They just didn't know that that was normal. And in order to try to reduce some of the volatility and risk, you should probably hold some of that, as well as the small cap, mid cap. Should probably try to get some funds together that don't all buy it based on the size of the company. That's called market cap weighting. Try to have other factors. Like I like the value-oriented ones, where they will actually eliminate some of those stocks that are overpriced, or at least the ones that are the most overpriced, because you can't eliminate all. Occasionally, almost all stocks get overpriced. So in that case, all you're doing is eliminating the ones that are the most overpriced. That doesn't mean that it's safe where it's like a CD, but you are reducing your risk. And that's that's a key. Keep the risk in check. You also do it by balancing between fixed income and stocks. Fixed income is a big, broad term. There's a whole bunch of different types. And when I come back from the next commercial break, we'll actually talk about that, because I've been talking with some people who are taking risk and they're not aware of the risk that they're taking. And you need to be aware of it. I take a lot of risk, but I know exactly what my risk is. And on some things, I take no risk whatsoever. Some things I have just sitting in a money market account. okay, because I don't want that money at risk. And I think I'm going to have to write a little ebook. Like, and I kept thinking about this. I've been threatening this for years. Little ebook that says you're making this way too complicated, because I really believe that the financial services industry and the financial planners out there, they make this all way too complicated. Rarely is it necessary that you've got to use more than 1 or 2 3-syllable words in a sentence to describe what you should be doing with your money. And so I need to get cracking on that in 2018, because, people can do amazing things. You young people out there, you're just getting in your first jobs. You're not really aware that the market fluctuates a lot. A lot of the millennials, people in their 30s, they are not real keen on taking risk. And the idea is not to take risk, it's to manage it. You want to manage your risk. That's the big idea. Manage the risk. How do you do that? Well, first of all, you expect corrections. You expect them. You will not be able to anticipate it. You will not be able to go to cash at the right time and get back in at the right time. And you do that more than once or twice in your investing career, and it's really going to put a big whack on you. I mean, it'll make it almost impossible to accumulate enough money or enough in your savings and investment accounts to be able to retire. So you need to get those thoughts out of your head, particularly today. It is 10 times harder to do that than it was when I was new in the business. And when I was new in the business, it wasn't easy then. It was not easy. There were a few things that actually used to work back then. They don't work anymore. In fact, there are lots of things that used to work 5 years ago that don't work anymore. They just don't work. And how do I know? Because I've been using them, and I've been making changes because I pay attention. So it's hard. I feel bad for people. I really do. I feel bad for the average investor out there. There are so many people out there that will just tell you what you want to hear to get your money. They're just going to tell you what you want to hear to get your money. And then there are other people. I'm a fiduciary. I'm not allowed to do that. In fact, when we work together, we are partners. I am partners with every single one of my clients. You tell me how much risk you want to take, and I'm going to try to keep your portfolio within that level. And that's kind of the key. I'm going to try to do the best I can to put you in the positions, in the funds that I think are going to, in the long run, be the best overall for you. And then we're going to monitor those things and make adjustments as necessary. And which is really kind of interesting. That's actually a whole show. I'll have to come back. How to adjust your portfolio. We'll do that next week. I'll tell you what. We will do that next week. Somebody out there, email me, remind me. But when should you adjust your portfolios? Because that's a big question. A lot of people just set it and forget it, and that's okay until you get in your 80s, and then you turn around and realize that you're 90% in stocks. That'd be a little rough. Because when you get in your 80s, you're going to the doctor quite often. In many cases, not everybody, but a lot of people are. And in order to go, pay your copays and deductibles, even if you have Medicare, and you've got to have money for that. You have a big drop in the stock market, that could really have a big impact on you. So your ability just to pay your medical bills. So just something you got to have a conversation with your investment advisor or yourself. And the one I use is we have a Morningstar questionnaire. I use that, but I've got a supplement there. And any clients that are listening to this, we'll talk about this in detail on our reviews. And basically, I'm talking about how much risk you actually want to take. Because it really doesn't matter what your age and financial condition is if you're doing something that's uncomfortable. Because you're gonna give it up. You're gonna quit. And I think one of the biggest problems that I have in my practice is people want to get the big returns, but they don't want to take risk. And then they don't really listen when you're talking to them about the risk that you're taking to be all in stock. They just block that out. There's a psychological term for that. It's called a cognitive bias. They see the facts don't agree with the way they want things to work, so they stick with the way they want things to work instead of the facts. And I didn't realize when I got in this business I was going to be a psychologist and a marriage counselor. Yeah, I'm just kind of kidding. But anyway, so this is a really good question for you to ask yourself. How much of a decline am I willing to sit through in my portfolio in an effort to reach my long-term goals? How much of a decline am I willing to sit through? You know, and in fact, I go through this all the time with everybody, and I love to point out the statement I read Warren Buffett had made when I was new in the industry. He said, if you couldn't stand to see the value of your stocks drop by 50% or more, you shouldn't buy stocks. And I thought he was kidding. I went running over to my branch manager at the time because I didn't know any better. And I said, hey, is that true? He goes, oh, that ain't ever going to happen. It was he didn't say it exactly like that, but something along the lines of, it very rarely does that ever happen. So don't worry about it. And the industry itself kind of avoid that whole topic. You know, those risk questionnaires they have, they're very confusing. I haven't seen a good one. In fact, the industry is struggling to try to come up with a method for this, and I think they should just use mine. I use theirs, and then I supplement it with mine. Mine is okay. The average fund, if you start looking from 2007 when the market peaked, when stocks peaked, to 2009, was down right around 50%. Some of them a little bit more, some a little bit less. Right around 50%. So if you can't take a 50% decline without panicking, you should not be 100% in stocks. You shouldn't. Because the idea of jumping out and jumping back in, well, just give that a try 3 or 4 times. And typically, those are my clients. Those are people who have tried that throughout their lifetimes and then found out how difficult it was and how miserable it was and decided not to do that. And if they tracked their performance at all, this is typically what happens. When they track their performance, they go, wow, boy, I really wish I had heard someone like Bill Bullington over there talking to me about this. And more importantly, I wish I would have listened. So it's a very difficult thing to try to get out of the market and get back in. Having said that, it used to be a lot easier. Today, I'm going to tell you, past 5-6 years, it's really almost impossible to predict that stuff. Anyway, I hear the music. That means I have to take a real quick commercial break. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we are back. Hey, you can always call us 216-901-0945. If anybody's out there driving on the roads today, as you can tell, I've caught some sort of a bug on my way to CVS after this for an appointment. But hopefully it'll be a little bit warmer by the 18th. That's the date of the seminar where you can come and take a look at the stuff that we've been talking about here. And we talk about it quite often. Again, 2018, I think it's going to be a really good year. I think the economy's doing well. I think stocks will do very well. If you have a 10 or 15% correction, don't worry about it. Not a big deal. It's really not a big deal. That's another thing that comes to mind when I mention that. The stock market has never gone down and stayed down. You know how you keep hearing that stuff and you see it on the internet, it's Armageddon, it's never coming back. That's never happened. And it's not likely to happen. I mean, when you look around at in the big grand scheme of things, it's extremely unlikely that ever happens. Now, can it perform poorly for extended time periods? Yeah. I think the S&P was went from I know the Dow from 1967 to 1982, it ended up exactly where it started. That's a long time. And if something like that happens, that's really tough on your retirement, by the way. If you weren't doing a lot of the things that we're doing, and you could end up running out of money during retirement. That's not a pretty picture. So you need to do those things. And the things to do are not to chase performance. And I got to tell you, what I mean by chasing performance is the only thing you can find for free on the internet about mutual funds or exchange traded funds is the performance. You don't really get the detail on how they're creating that performance or what kind of stocks they're buying. And the vast majority of people, when I'm looking at someone's portfolio that set an appointment, came in and said, would you look at this for me? I said, sure. Most of the time I'll say sure. And I take a look at it, and the stocks that they have in their mutual funds are all holding the same stocks. And they feel like they're diversified because, they've got 10 or 12 different mutual funds out there, and I've got to be diversified, right? Well, not really. And I know how you picked these funds. You picked the best performers over the time period that you're looking at. And guess what? The funds that are all the best performers are all holding the same stuff. So that defeats the diversification portion. And by the way, when you pick your funds that way, you're really setting yourself up, because those things at some point in time will have a big correction. And then you're going to have those stocks duplicated in each and every one of those mutual funds. So your correction can be a lot bigger than, say, a correction in the Russell 3000 or an equal weight 1000. So anyway, I would encourage you not to do that, not to look at it that way. When you're looking at mutual funds or exchange traded funds, you really need to read the management's discussion. That's a 10Q. I'm sorry. I was talking to somebody before the show about this. You really need to read the prospectus, and the managers will tell you what they're trying to do. In exchange traded fund, they tell you exactly what they're going to do. They don't leave anything out. That's one of the things I really like about exchange traded funds. Not only are they super inexpensive, like average equity ETF, probably 30 or 40 basis points. Some of them are only 10 basis points. Some of them are actually less than that. And the basis point, by the way, is 1/100th%. So if you're 10 basis points, that's 10/100th%. Very inexpensive. So it's a lot easier to get diversification today than it has been ever. That's one of the changes that's happened over the past 5 years. A lot of the big institutions were kind of demanding these products, and I'm not talking about the multi-billion-dollar. I'm talking about a pension fund that's got $400 or $500 million in it, maybe $100 million. They didn't have the same access that the billion-dollar pension funds had to Russell and Standard & Poor's, helping them do consulting and setting up these indexes in their own funds. So sooner or later, actually BlackRock and I forgot which one does the spiders, State Street, First Trust, they saw an opportunity there to create these products for these smaller pension funds they were still big by any stretch of the imagination, but they weren't big enough to get these other investments in their portfolios. So they went after those first. Actually, initially, a lot of them went to the general public, and they didn't get enough assets to pay their expenses, and they had to shut them down. That was so frustrating. That used to happen. Actually, I think it was 2 years ago. That still happened to me. You don't get enough assets in a fund, that fund's going to shut down. And what's really disturbing about that is when they shut the fund down, it takes them about 30 days to do all the paperwork, and you see that value that used to be in that fund, it disappears from your account for 30 days. It's not that you don't have it, it's that they can't come up with it's not there yet. It takes them time to unwind a fund, and in the meantime, it looks like you might have lost that money. So you have that happen to you 2 or 3 times, and you end up not doing that anymore. And nobody lost any money over anything like that, but it sure does get upsetting, and it creates a lot of phone calls for people like me. So I had to wait until these funds got enough in assets. All the funds that we're talking about, they've got enough assets to stay in business. They all have 6-year track records. That's actually the youngest one is 6 years old now. So, and we know exactly what they're doing, why they are in the portfolios. It's a great thing. It's really transparent. Well, it's a lot more transparent than it ever has been, by the way. And that's another one of the changes. And I'm going to show you what I mean by that. I'm going to show you how you can actually access these things, look at the holdings within the funds themselves, because I think it's very important that you get comfortable with what you're doing. You got to get comfortable. And once you get comfortable and you look around and go, this is actually pretty easy. And it is. Once you get comfortable with it, you get your arms around the subject, then you can relax. And wouldn't that be great? Being able to relax over your financial situation. At least most of the time. And it's always scary, believe me. Markets are going down. It's scary. That's probably one of the reasons I have a job, because it's scary. And a lot of people, they don't want to do that by themselves. If I weren't doing this for a living, I wouldn't want to do it by myself. I wouldn't. I'd go out and find somebody that was just like me. They're out there. I'm sure they are. And it's a pretty good thing. I'm just looking at these stocks. Sorry about that. There's one scan that I like to run, and it's got 68 stocks on it on Friday. That's an unusually high number, because the scan is relatively strict. So to make it into this group, typically you'll have, maybe 20 or 30, but to have 68 come up on one day is that's a big deal. Yeah, I really like it. I'm looking at their charts. They look good. I'm looking at the valuations. Not bad. This is what I'm talking about. I look at this every day, sometimes 2 or 3 times a day. And I'm telling you, if you get a 10% correction, you got to be ready to jump. You got to be ready to go. And if you get a 10% correction, then what you want to wait for is you want to take all the stocks that are big enough for an institution to own, which means it's going to have to be above $250 million in market value, because your bigger funds can't go below that. So you want to look at all those that are investable by a fund and break them down into those that are in a short-term uptrend, and then compare that to those that are in a short-term downtrend. Now, there are about 3,100, almost 3,200 stocks big enough for an institution to invest in. Okay. There's about a little over 3,100. Right now, 2,000 of them are in a short-term uptrend, which is kind of funny, because I've had so many people calling, market's going to crash, what are we going to do? Well, we're going to do the same thing we were before, because you can't actually anticipate that when it's going to happen exactly. And we've got money sitting in bonds, and we can reallocate that. If we get a nice correction, once the bludgeoning is over, and we don't know when it's over for sure, but there's some things that you can do. Like, I'll look at this, and this will turn very negative. I think at one point in time, out of the 3,000 some odd stocks there were, only 300 or 400 of them were in an uptrend. That was during the depths of the big correction. When only 10% of the stocks are in a short-term uptrend, that's a little rough. Now that I hear the music, you'll have to wait till next week to find out what to do about that. Anyway, you've been listening to Bill Bullington here. I'm here every Saturday morning from 11 to noon on 1420 The Answer. Have a good week, everybody. Good luck and good investing.
You just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420 The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and or investment strategies recommended and or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional. The preceding program has been paid for by Bullington Capital Management, LLC.